Hello, everyone. I hope all of you are having a lovely morning. Although we're waiting for one of the panelists, I think we'll go ahead and start for the benefit of time. As we get started, firstly, I'd like to express a lot of gratitude to be in the presence of some incredible folks here. We have a very diverse panel of ex-founders, very experienced investors, folks with a lot of cross-border experience, global exposure in investing, somebody from a legal background, and somebody reasonably younger who has a lot of portfolio exposure currently considering the times. The idea for the next 40 odd minutes is to uncover and separate the noise and the signal. A lot has been said and done, and I'm sure there was a panel before this on profitability in the current ecosystem and what's the chatter around it. But when it comes to the funding winter, there's so much jargon out there, much of communication, but a lot of lack of substance, I'd say, right? And that's with a caveat that we all know so much, but I want to take this opportunity to clarify much of it. And as we get started, maybe I'll just throw a question broadly, openly to the panel, which is to say that when we think about bear markets and their sort of extremes, how do they actually play out in the business cycles, right? Like, are they a necessary component of what happens, or should they be treated as a shock? Feel free to take this, whoever would like.
Sure. Is it? Okay, yeah. Look, happy to go first. Hi, everyone. I'm Salone Sehgal. I'm the founding general partner of Lumikai. So I think with, Charlie Munger says that if you invest in, let's say, the markets, there are going to be periods of agony, and then there are going to be periods of joy, right? So if you have seen, and as all of us have seen, over the last few decades, there has been a severe period of, let's say, market outperformance. Inevitably, it is followed by a period of market underperformance, and it is simply because when things don't go well, people become cautious. And when people become cautious, things start to go well. And as they start to go well, people become less and less cautious. And that's a forever cycle, right? And Howard Marks says this. And I think what's ultimately really important is to try and understand the period of the market cycle that we are in currently, especially in the global scenario of what's happening in the funding environment right now. I think markets ups and downs are inevitable. I've been an investor and I've been in the investor space, I've been an entrepreneur, I've been in investment banking and private equity. I have seen through 3 bear runs and bull runs, and I think it's par for the course.
Absolutely. I mean, it's always great to have this reiterated to understand that this is a part of the natural course and nothing abnormal about it. As we proceed, I think it'll be interesting to understand what's maybe happened in the past, and then maybe come to Padmaja for that. If you can maybe share from your experience as to how bear runs have played out in the past, what your experience has been, and how that plays in comparison to what we're seeing right now.
No, I think what Lumika says is correct. What goes up comes down, and what comes down goes up. I mean, that's the cycle that we will continue to see. So this is not an unusual cycle. I think there are 2 perspectives to this. From the perspective of entrepreneurs, I think what this is allowing entrepreneurs to build even a much more sustainable business. Cash flows have to run for a longer time. You have to start thinking of unit economics you really have to start thinking how your unit economics are running. Debt starts becoming a little bit more attractive, if your cash flows are running well. I think what it is, and some very good solid foundation companies start emerging, because they are not only emerging when they are in the downside, and to be honest, in the bear markets, you see something called job losses. So excellent talent emerging, right, and creating companies. So I think this is not a bad situation. I think this is a great opportunity to build very good, solid foundation, sustainable businesses, and I would see it like that. For investors, if I look at it from another perspective, we've seen 2008, we've seen 2015, we are seeing 23. I think the way I look at it is that good businesses will always be investable because investors still have their business is to invest and make money. This is a great time to buy. Valuations are low. Good, solid businesses, you have to do a lot more work. I don't deny that. But I think there are great opportunities sitting out there, so it's a good way. I think the issue is really, if I may say so, is that if you are not on a sustainable model kind of a business, then, and relying more on next rounds, that's where the rubber hits the road, right? Because that's a tire burning situation. So all in all, even historically, if you go back, whether in the US or in India, some great companies which are icons today have actually emerged during bear times, right? So I think that this is going to happen. All I can say is as you grow your business and you gather more experience, every time the markets go up, start planning for the markets that they will go down. So start planning when you are at an high.
Absolutely. I think those are very interesting insights. And while we've gotten multiple perspectives, I'd love to go to the founder plus investor perspective with Arjun as well. Before I do that, I'd love to wake the audience up to the tune that we want to make this very interactive, and I don't want to be the bottleneck here. So we'll take the last 10-15 minutes for a good couple of questions from all of you. So please keep your notepads in run. We will take questions at the end. But as we come to Arjun, Arjun, since you've gone through that, founder journey yourself, you've seen multiple cycles, and now you're on the other side as an investor, considering that empathy perspective is just way higher, what are you seeing and what can founders do to make of this situation? What do we see there?
Yeah, look, I'll say first, big thank you to Delhi for hosting me here. I've come from Bombay, but I'm loving the energy. And when I talk about energy as well, I sold my business in April 2021. I would say I sold my business at the height of the excitement, right? The D2C wave and all of that happened. And so we sold Dr. Vaidya's in 2021. And that's when I started my journey as an investor. First off angel investing and now running a VC fund as well. And I'll be honest, I drank the Kool-Aid, right? I started thinking to myself that everything that we do in the new age digital economy is the solution to all the world's problems. I come from a traditional family business. I would have dinner table conversation and say, you guys don't get it. Like, this is the way to do it. You just scale so fast that eventually you figure out what the answer to the problem is, right? And so I think from that perspective, that energy allowed or made a lot of us start believing things that weren't real, and I'm guilty of the same as well. Now, when we look at where we are today, and I think we got here sometime in the mid part of last year, while it may seem like a bear market, the reality is I now run a VC fund, but our parent has offices in the US, in Europe, in the UK, and in Southeast Asia. Everyone is most excited about what's happening here. So for context, from 21 and 22, this looks like a bear market. But I went to raise money in 2017, 2018. And I can tell you, we're much better off now than we were then, right? So if I think about founders' empathy perspective, I would say the best thing to do is if you have actually started off or started building in the 21, 22 era, erase some of that. It's easier said than done. But start thinking, as Padmaja said, about sustainability and real business models, right? You got to ask yourself tough questions, which aren't easy to do. And because I had a father who's run a traditional business, I'd get asked all these tough questions like, you think you're doing so great, but you're burning a lot of money, right? And I think once you ask yourself those tough questions and you put a mirror in front of you and you actually see what will happen over the next 2 years. Am I contribution margin positive? Words like EBITDA and bottom line are being used by investors like us, which we didn't use so much for the last 2 years. I think overall, we're in a good place for good businesses, right? And in this market, the difference between good and not so good businesses will be much more stark. But capital is flowing. Investors have raised money. that has to be deployed. If I look at India in the perspective of the world, and because we're in India, sometimes we get caught up in what we're seeing just around us, but if I look at India in the perspective of the world, we are in a very, very special place right now. And so from an empathy perspective to founders, I would say that maybe it's a little bit tougher than it was over the last 2 years, but it's only going to get better.
Just to add a little bit of data perspective to a few data nuances to the discussion of ups and downs of business cycles and their impact on funding in India. So we've been doing this analysis and keeping a track of funding trends in India, etc. And it's so evident that cycles go up and down because, like it was mentioned, post 2016, we saw a cycle where immediately after the aftermath of currency fluctuations and the bear market resulted in 2 years of lesser funding rounds and flat years in terms of dollar funding in India. But this was again immediately followed by the best years in terms of funding exits as well as the amount of funding going higher. I think what's very interesting is that during this phase of 2016-17, almost up to March 2018, if you look at the revenues of the startup ecosystem, which we measured by looking at basically audited financials across for venture-backed tech startups, we saw that revenues actually, the annual growth rate of the entire ecosystem sort of decreased in these years. It was roughly about 15% compared to 40% if you look at the average from 2012 to 2020. But immediately post that time, the best years of revenue growth, funding, in terms of number of rounds, in terms of dollar value of funding, everything went up. So I think clearly macro has an impact on the amount of funding as well as revenues in the Indian startups.
Absolutely. I think those are crucial data pointers. And to what Arjun said, I think always long in terms of the ecosystem and long India in the larger scheme of things if we zoom out. But getting a bit more tactical here, right? And coming to Saketh perhaps, you've seen the portfolio and we were discussing this off stage. You've been working very closely with the portfolio and understanding what the on-ground reality of companies is right now. Can you maybe shed light to what founders and teams are going through at this point and what can be done from a more strategic lens to navigate the next 12, 18 odd months?
Got it. So I'll start with the flavor of conversations that I'm seeing from founders within our portfolio. There are 2 to 3 positive trends. Number one, I think founders believe this is a time where they can actually focus on building the kind of business that they've always wanted to build. Businesses are a lot more geared towards, especially early stage startups, are a lot more geared towards building versus handling external chaos. From a market where a lot of good talent was being bombarded with offers on their LinkedIns, today founders feel like they can manage a tight ship, retain good talent, and build using the teams that they have. So internally, there's a lot lesser chaos, which gives founders the belief that they can navigate the ship that they're leading very well. If I extend the logic out a little bit, surprisingly enough, in the markets outside as well, the chaos has decreased. We're seeing this especially with SaaS startups in our portfolio, software as a service products that are building from India to other Indian startups or selling to startups outside. And what we're seeing is customer personas in SMBs and enterprises who were bombarded with a lot of offers and a lot of SaaS companies pitching to them are seeing a lot lesser companies. There is a lot lesser chaos actually in the market outside. By the way, these companies also have lesser spends to invest into these software companies. So again, like people are taking, the decision makers are taking time, having conversations and investing into cost-effective products, which is where Indian SaaS companies are doing very well. We are seeing this, albeit to a much smaller extent with our consumer portfolio as well. Lastly, in terms of growth, which are important conversations between founders and investors in this market, about 90% of our portfolio is organically geared towards, they've pivoted their mindset at least towards building a fundamentally strong business. Now, like it was mentioned, a fundamentally strong business could mean strong unit economics, figuring out your ICPs or figuring out your go-to-market well. in order to ensure that if you have a fundamentally strong business, once you have the cash, you can pedal on growth. So I think these are some of the things. What companies are doing, I'll quickly cover. I think one, there are 2-3 companies in our portfolio, and across the ecosystem, you will see a few companies who have very little cash, and unfortunately their fundraising cycle matches with this down market, and they're not yet ready for future investors. In those cases, you take drastic actions. You cut down teams, you fire people. In a lot of other cases, we've seen that down markets are actually good for businesses. They're necessary for businesses to understand if they can actually sell to customers and get the kind of growth in revenues despite the business cycle. And if you don't, you'd much rather correct for that because you want to be business cycle proof. So we're seeing business pivots. And the third category of startups are where they're actually not changing anything. Life's as good as ever, and it's actually better for them to build in this market. So tactically, we see these companies, and these are the kinds of actions.
Yeah, I'll just weigh in on that from a legal regulatory standpoint, because obviously our startups are competing for capital with startups all over the world. And therefore, I think it's quite important for the regulatory framework to provide as much support as is possible. Now, in the context of, say, someone who's actually going out there, I think, there's a point made on the panel about, having a hard conversation to begin with yourself and figuring out that, now is the time that I need to go and raise capital. What are you going to do? You'll do a flat round or a down round. And in India, given how the exchange control regulations work, if you're looking at, typically if you do a flat round or a down round, you're looking at a convertible note structure. And typically how that would work is that, you would essentially suppress the fair market value, raise at whatever price, and then ensure that your convertible note converts at a price, which then gives you the arbitrage that you're looking for, based on a future perspective. But with the whole angel tax move that has come about, right, that's just a recipe for, getting taxed, because that whole, fix no longer works from a tax standpoint, both if you're a domestic AIF or a foreign fund. And, query whether this means that now we need to start looking at, FVCI registration across the board, because, that's one of the exempt categories, or in whichever pocket this will work out. But I think what's happening is that some of the tools of the trade that are available to deal with this situation and, allow companies to, who are prepared to give the higher seniority and the lick pref and, whatever coupon on, on investment amount and things like that. The people who are willing to go through that test, through trial by fire. But still, the tools of the trade are, that way limited in terms of what you can do on the cap table. So I think that's something we need to really think about hard. I just thought I'd weigh in on that.
So I just wanted to add, I completely agree with Bharat. We are a very confused country. On the one hand, we've sort of liberalized, quote unquote, that FDI in restricted areas sectors can come in through the SEBI structure. On the other hand, we've got the angel tax, right? So I personally am also very confused that are we inviting foreign capital or not? But having said that, I think there is a huge opportunity that we are sitting on. Today, as a country, as a startup ecosystem, what we have done is we've created some, in even larger ecosystems beyond startups, we've actually been able to innovate and build things here at a very, very efficient pricing, right? If you look at a couple of things here, for instance, if you look at space, it's a great opportunity, right? Mangalyaan started the trend of building, going out there and competing with NASA and actually building a very capital efficient rocket out there. We have companies like Dhruva Space who are actually now working for overseas US companies working here. And therefore, there is a whole new go-to-market that you can do on the back of talent and capital efficiencies here. That's one. The second is, it is during the down rounds, the down times, when the times are tough, that the tough get going. We've heard that before. But I'll give you a live example. When the pandemic hit, and in the first lockdown, we had a company which was into solar panel cleaners, robotic waterless. The company was going nowhere. It would have been shut down on 1st of April. It was that bad. right? The company, actually the founders turned around and built a ventilator. We as investors created a 20-member task force to support them on Zoom calls for 95 days from 12 to 2 p.m., 7 days a week. They landed with a functional product duly approved by the government and all regulatory bodies, signed up with a public sector unit. In 15 months, they had installations in 3,500 hospitals, right? And their revenues, they laughed at their way to the bank. So when the tough times hit, when you think you can't do anything, you can't even move out of your house, look what companies can do. And this is what I think what entrepreneurs are. That's the genetics of entrepreneurship, right? That you are nimble, you're able to think disruptively, you're able to grab opportunities. So I think what happens is you actually can innovate when you're under stress and come up even a bigger winner. That's where I'd like to leave it. That it's not all doom and desperation and depression. I think there's a lot of opportunities out there, potential. Just pull it out of yourself and you can make it happen. That's what I would say.
I was going to make one more quick point, which is that, you know, and I completely agree with Padmaja. I think there's a lot of opportunity there. But, you know, if you're going and looking for capital, and suddenly you say that, look, your traditional route is drying up, or, you know, people are on pause, let me go and speak to, you know, corporate venture capital, let me go speak to SWF, right? They're very different animals as investors. And if you have, you know, so sort of say you've got some funding lying there, 20, 30, $40 million worth of funding raised, and then you're talking to a very different type of sort of P&L driven, you know, CVC or an SWF, which has a much longer perspective, whereas you've got folks sitting on your cap table that are looking at sooner exit. Those kinds of situations require, you know, I mean, resolving those kind of cap table challenges, which is what we end up doing in terms of our day job, can create struggles, right, and real philosophical challenges. And so I think, you know, for folks who are looking at that aspect, you know, I would just, you know, sort of urge a word of, you know, think about it philosophically, because the philosophies are very different.
Absolutely. No, those are all very, very crucial pointers to take note of, and a lot of consensus and interesting perspectives there. We're almost at the halfway mark. To get a quick sense of the room, if you're liking the insights on the panel, can we get a strong yay? Or a okay, so we have the room active. I'll have 2 more questions open to the panel, post which we'll come to all of you, and we'll have a mic circulating. But I think one of the things, and this is out of pure curiosity, as folks who are in the audience and not in the day-to-day, there's a lot of noise, right? Which is to say that there's, you know, the Go Mechanic unfortunate incident that happened, Silicon Valley Bank that happened, something or the other keeps happening. How do you separate that noise and what is that signal, right? Like, what do you eventually believe in and what do you follow when it comes to like on-ground insights?
Yeah, you know, I'm a little less sanguine than the rest of the panel on this. When we look at macroeconomic perspectives and when you see what that means for, let's say, Indian companies and Indian startups, right? You know, a lot of people have said a Go Mechanic and a Silicon Valley Bank and all of these things have been products of a environment which was, let's say, a zero interest rate regime, right? And we've kind of covered this as to how macro impacts the micro. And that has never been more true, especially in the last 3 years, right? What we saw in the last 3 years, even as an investor, has been a period which was discomforting to, I think, most people in the world, right? It wasn't just about, let's say, a loose monetary policy which, you know, loosened purse strings, but it was the fact that we went through a black swan event like a pandemic without going through a recession, largely because Western governments decided that they would print a ton of money and they thought that it would have absolutely no consequences. And that is exactly what happened, right, in 2020 and 2021, why we saw the startup boom and why in 21 we had a unicorn coming nearly every week, was because of the US and largely the Fed, right? And there is much credit to be given to the Fed for our lovely blossoming Indian startup ecosystem, is because if we look back at the numbers right? There is a number in the US, it's called margin debt to GDP. It is essentially the number, and it is actually money that the government gives to people or people borrow to invest in the stock market, right? At the peak of the previous crisis, if it was a tech crisis or whether it was a great financial crisis, margin debt to GDP was about 3%. In 2021, margin debt to GDP was 4.5%. What that meant was people invested in meme stocks, people invested in crypto, NFT trading was at an all-time high, startup investing was at an all-time high, investments into PE, VCs were at an all-time high, and that essentially flowed into India, right? A lot of that capital for the very first time flowed into India at a point where it was absolutely record-breaking, right? In 21.
Because China was also closed.
And also China was closed, exactly, right? So India had about 60 odd billion in 21 and another 40 odd billion in 22. Now, if we were to see what's happening at this moment, is essentially when you print that much money, the economy overheats. So the only way to do that is you tighten interest rates. So a Silicon Valley Bank happens simply because the Fed raised interest rates and ramped it up from near 0 to 5% in a matter of 12 months. So SVB on one side had to pay 5% interest on deposits, but it was actually yielding only 2% on its securities. And when that happens, crisis happens. So this is exactly what is happening in the US. Now, if we were to make parallels and say, okay, well, what does this mean for the hedge fund industry, the PE industry, and the VC industry? Essentially, everybody who thought that they could count on an ever-flowing LP capital flow is now going to go back and rethink, right? Because now you have earning much higher yield in less risky assets, which means that capital for private equities dries up. When capital for private equities and VC funds dries up, capital for startups dry up. And that's essentially the chain. Now, a lot of Indian startups end up raising money globally, right? Especially the Series B, the Series C, the Series D, and so on and so forth. That is such a major capital gap which is going to emerge over the next 12, 14, 18, 24 months because the US is in a big problem, right? If you were to, let's say, see what stable state inflation in the US looks like, it's about 2%. It is currently at 6%. So the economy needs to significantly cool off before we can go back to the last 2 years. So now, if you're an Indian startup who's looking to raise these large rounds, seed, pre-seed, Series A, there is still no problem because Indian funds are very well capitalized to be able to support those companies. The problem comes when these companies have to then raise much larger rounds. So where do they go? So now you have a lot of startups going around Middle East. There's a lot more Japanese capital, a lot more Korean capital, etc., which is coming into the market. But the situation now is going to be what is that alternative source of capital which is going to now help these companies grow. And I believe there is going to be a significant gap over the next 2 years or so. And how do startups and Indian companies, especially who've been incubated in the last 2 years, who feel there's a constant tap of money, what does that do to founders? And I think those are going to be critical questions.
Awesome. And that's, I think, a very, very interesting summary of the entire landscape and gives us clarity on macro and how the US environment impacts India. Since due to the paucity of time, we'll come to questions now. Instead of doing questions and then question, answer, we'll take all questions at once, which will be about 3, 4. So whoever has one, please raise your hand, we'll come to you. And then we'll leave the floor open to answer whoever's relevant here. So go ahead. I see one hand. Can I request a mic to get circulated to the hands in the room?
Hi, panel. Question for everybody. Like, as the winter of investment is a autumn of investors, because in the last couple of years we have seen a lot of investors as every type of investors are coming up in India, like angel investor, VC investors. So more investors, less investment, how is it? A lot of bad fund, good fund kind of things happening.
Awesome. We'll get to that. Thank you for that question. Yes.
Hi, this question is for Bharat specifically. Considering very SaaS companies and Series B and others, certain organizations flip their structure more to get funds from US. What are your thoughts on this going forward?
Awesome. Thanks for that question.
Hi, it's for everyone. So what kind of trends or environment do you think exist right now for edtech funding in the market?
Okay. Perfect. We'll take one more. Can we get to this part of the audience? Yes.
Hi, thank you. So I'm sharing a founder's problem here. The question is for Arjun specifically, since he has been into D2C a lot. So be it any form of business, be it a manufacturing product, be it a bottle, be it a food product, there's a certain scale at which you can get good gross margins, right? So how do we phase it out? Like, for instance, I'm doing a 50 lakhs MRR currently. I know that I'll make good margins at 5 CR and I'll be a bit positive. So how do I phase it out in terms of my fundraise, in terms of my planning? So that is something that I'd like to know.
Got it. Thank you. We'll probably do a equal, since we have 5 panelists, we'll do one more question. Do we have another hand in the audience? Okay, maybe not. So just to summarize for the benefit of everyone, we have one question on the overall environment and how the funding winter overall, does it mean a boon for investors and does that matter? We have specific questions for Arjun and Bharat, and we have a general question more on the edtech side, right? Please feel free to proceed as you'd like.
Yeah, maybe the first question, right? And I think it's an interesting question. I would say that there's 2 type of investors that you are talking about. Right? You're talking about angel investors and you're talking about institutional capital. Now, institutional capital has a longer cycle, right? Because even if you raise a fund in 2020 or 21 or 22, you will take 2, 3, 4 years to deploy that capital. And so even if there is a winter of investment, at some point you've taken money to deploy that capital. So that capital that's been raised may be more cautiously deployed, maybe deployed at lower valuations, maybe deployed in different types of businesses or structures, but that capital will be deployed. Now, if you look at the other sort of part of investment that you're talking about, which is the angel investment, right? I think over the last 2 or 3 years, we saw an unprecedented rise of people investing in this asset class. But the reality is that this asset class is very, very different from a listed equity. And the biggest difference, right, other than the success rate, the chance of failure, etc., is this asset class is completely illiquid or illiquid for a very, very long period of time. And so lots of people who ended up doing 2, 3, 4 startup investments in a very hot market, and then when the market cooled off, realized that there's no liquidity for any of this stock that they own and they have to wait for a very long time, went away, right? And so I think from the angel standpoint, and I had lots of people who are not from our ecosystem, including my aunt who said, just take my money, put it wherever you're putting it and see what happens, etc. And you know, even if I talk to my dad as well, I would say there will be lots more caution and a lot more reduction in this capital available. So that's how I look at sort of what you said, very interesting, which is the winter of funding and autumn of investing.
If you like,
So
I can just take the...
So I'll just add to what Arjun said, to be honest. I think irrespective of upturns or downturns, this asset class investing either as an angel or through a VC, when you invest in very early stage, it is given that it's a very, very, very risky investment, irrespective of structure. Number 2 is that you should only, and I say this to a lot of investors and I'm saying it, is that only invest what is disposable wealth. Something that is not going to impact your lifestyle, your children's lifestyle, your education, none of that, and you can sleep peacefully. You don't need to call either the fund manager or the company and says, "Is hafte kya hua?" That doesn't work because young companies take a much longer time. Their gestation periods are much higher. Number 3, I think because it's so risky, I think the investment thesis is not on what rewards you can get. If you're building a portfolio on the basis of what's your risk mitigation strategy, I think then the returns work better. And there's also constant, after 3 years or so, a constant return of money coming in. So investing in one company and saying I'm an angel, I'm taking a very extreme example. If you invest in one company and say I'm an angel investor, honestly, that's extremely high risk. So create a risk mitigation strategy across sectors, across companies, across geographies, co-invest, do angel groups investment. You're leveraging each other's competencies and understanding. So I think it's very, very important in early stage overall to develop your investment thesis on a risk mitigation strategy than a return strategy. If the companies are giving returns, I think the credit goes to the founders. But if the portfolio is giving you returns, then the credit goes to the investor. That's how I look at it. So if that helps you.
I can quickly take the question on the flip structure. To my mind, clearly, point number one is that the rules now allow it. So you can set up a flip structure without worrying about things like round tripping and those technicalities. The hard question you have to ask yourself is, why are you doing it? Is this a personal lifestyle choice because you want to relocate? Or is it because your business is of a nature that can't get funded in India? I think a lot of the people who implemented flip structures, at least under the earlier regime, have come back into India for exit purposes or are looking at restructuring to come back. A couple of other points. I think one is that, look, to my mind, if you are going abroad and you want to run a foreign cap table, you have to reconcile with the fact that the governance is based on what is par for the course in the valley or in the West, where founders don't stay as founders of the company right until IPO. I mean, I think unless you're Bill Gates or Steve Jobs or someone, it's a very different expectation setting. So mentally, are you in that frame of mind? So I think those are some of the hard questions that you really need to ask yourself in terms of why do you really want to do it? Just stop there.
Yeah, I can take the EdTech question. Look, I think in EdTech at the moment, it's obviously had a really tough time, right? Existing EdTech companies have been plagued by very high costs, and obviously they've also been able to unit economics, and proving out those unit economics has been a challenge. So if you are a new age edtech company who's looking to build, I think there are two things to demonstrate here. One is to be able to really show positive LTV CACs in a meaningful way that can get investors interested in the fact that this is a venture outcome. And the second is to have some degree of product innovation as well as a very well thought out distribution strategy of what you're going to do differently, especially with respect to the incumbents and what you're going to do differently from incumbents, because there have been a lot of lessons that are there to be learned. We very recently backed a company called Supernova, and they're essentially overcoming the high LTV CAC problem, the high manpower cost problem by having a gaming native pedagogy, which is tech-based, extremely scalable, and they're using now generative AI to really bring down costs. So they're able to have very, very low cost outcomes and at a very reasonable price point, reaching to a very high volume of users. And the way they've done it has been very differently, because they've been able to showcase both product innovation and an alteration in their distribution strategy. So if you are approaching a sector which is highly capitalized with very large incumbents, it is going to be quite imperative to be able to showcase how you're differentiated from what's currently out there in the market.
Awesome. Thank you. Last question to Arjun that was directed.
Yeah, I think interesting question. I'll tell you how I used to help founders think about it, right? At Dr. Vaidya's, other than our brand business, we used to run a factory. And so at 25, I got those lessons of running a factory, cost, raw material pricing, etc., all of that. We started a business line in contract manufacturing or third-party manufacturing with the sole objective to help early-stage founders who don't get any years when they have low MOQs. Now, the way I would plan it, and the way I suggest you look at it as well, is go to your manufacturer or manufacturing partner and say, today I'm buying 2,000 units. And usually our first order from these startups was 1,000 or 2,000 units. But we would give them costing for 5, 10, and 20,000 units. So we would do 2x, 5x and 10x what they are buying from us upfront, so that they could also understand that today I am getting this product from this supplier at a 35-40% gross margin, but that's not real because I don't have scale. And when I have scale, this will look like 60, 70, 80% gross margin, which was real in our space of health and wellness products, right? If you're able to actually get that data, then you're able to plan the future of your business better. Having said that, I would say operating at really low gross margins and hoping for this in the long term will not work. Look, the reality is in D2C brands, we are running P&L businesses, right? If your contribution margin negative, it went on for a little bit of time, but it's not real, right? And so even at the low MOQ, at least aim to break even on your first order and make money on your second order. And then sort of head office costs, other branding costs, marketing costs, eventually you will have to break even and make money. But we are P&L businesses. As consumer brands and consumer businesses, we cannot hide away from those. And we have to live in that paradigm. So these things can help you, but still think P&L. It's really important.
Lovely. Great. I think that concludes the questions from the audience. We still have a minute exactly, so maybe we'll do something interesting.
We ask you a question.
I'm happy to, but we'll take leverage of the fact that all 5 of you are here. Maybe to end, one sentiment for the next 12-18 months, one thing that you are expecting for the 12-18 months, and one question that you are trying to answer in the next 12-18 months. We'll end with those ones, each of you. Please feel free to go in any order you'd like.
So, okay. So I think the next 12-18 months, what I'm expecting is some great startups to be born, honestly, because new opportunities have emerged. We've had almost 3 black swan events, or at least 2.5, pandemic, Ukraine, and the US is already, we are in the midst of it. So I think these are opportunities if one looks for it. There are new opportunities. Pandemic clearly opened up the digital space. Ukraine opened up semiconductor chips in India. So I think I'm really expecting some interesting startups to come up. And that's what excites me, to see those coming up. And now we have 1,000 crore fund with Iron Alpha, so I'm itching to write checks, if I may say so. The second piece is what I'm expecting a lot of our portfolio companies and what we are advising them, daily dashboard on cash flow, literally, right? You have to make the money run further and longer. We invest in early stage startups, and that's why I'm coming from that perspective. You will have a problem raising money for the next 12-18 months. It's not going to be easy. But I also believe, and we are working very, very hard on that, that our companies are not only solid foundation, but they are compliance is done, good governance, good teams, and we are trying to build that so that 12 months down the line, they are able to raise monies at good valuations. But cash flow, cash flow, cash flow is all we are telling them. And keep your head down, do the Sherpa walk, and get it there.
Yeah, I'll keep it really short. 2 sentiments. One, I'm long on India, so stay hungry, stay foolish. And the second one, head down, cut the noise, and keep building. And the question I'm actually excited to see the answer of over the next 5 years or maybe decade is how mainstream startups are going to get and the startup ecosystem is going to get.
Yeah, I think for me, the sentiment is be greedy when others are foolish, and be greedy when others are fearful, and be fearful when others are greedy. And I think this is a great time for that. The question that I'm hoping to see play out is the India digital monetization story, where we start seeing digital spends really go through the roof, and really see people spending a lot more. India's been plagued by this of Indians don't pay, and India is a low ARPU market, and that's that story I'm hoping to see over the next 2-3 years unfold.
I'll just maybe talk about what I'm hopeful about rather than my sentiments. I'm hopeful that there'll be better governance, and this is a great opportunity to think about that and implement that and better internal control. And the second is maturity on the negotiation table. I think there's got to be some expectation management and maturity as we resolve problems. I think all problems that people have spoken about potentially are resolvable.
I think the emotion for me is that's going to be important for founders is resilience and the ability to be flexible. And the question that I have in my mind, very similar to what Salone said, is if the India internet opportunity is beyond payments and beyond maybe scrolling through videos, can it extend to beyond the 50 to 100 million Indians that actively are monetizing?
Awesome. That was lovely. We ended with a quite amazing insights. Can we have a huge round of applause for the panelists?
Hello. Yeah, and I just wanted to say one last thing. Thank you, Jivraj, for always being an amazing moderator. It was a really great session and wouldn't have been the same without you. Round of applause for Jivraj, please.
That was an incredibly insightful session to these panelists. And with that, we would love to felicitate you with our gifting partners, gifts from Naturic Company. Please accept that. And thank you, Pasna, for felicitating our panel. Can we again give it up for this incredibly insightful panel, please? With that, I would also love to quickly thank our co-partners, Khaitan and Company, Indus Law and Chiratae Ventures for their support, and our investor partner, IAN Fund for their support. Yeah. So there's also another parallel session going on in the Royal Room, which is just opposite the registration desk. Also, please know there is a booth outside which has books from our charter members. Do check them out. And also, just so that you know, we will be slightly delayed with our lunch, but then you're always being fed with incredible insights here from this fabulous panel. And the next one is something that I am very passionate about, because being a women entrepreneur, something that I look forward to